We spent more than $136,000 on Facebook ads over the last 6 months, marketing 4 different investment opportunities. And in this video, I'm going to show you the key lessons that we've learned over this time. I'm going to break down for you exactly the key numbers that we're tracking on a day-to-day basis that you can copy to get results for your business. And I'm going to go in detail what levers that you need to focus on in the ad and the sale process in order to deliver greater results for your capital raising business. And if you don't care about spending money on Facebook, these metrics are still just as valuable for you to know if you're serious about growing and building your capital raising business. Let's get in. So here are the KPIs, or the key performance indicators. These are essentially the measures that we're tracking at every level of our ad, of our ad process, of our sale process. And these are going to be really important, making sure you're staying on track, or that we're staying on track whenever we're running ads. The first one is CPAL, cost per accredited lead. And this is really, really important. It's not just about leads coming in and cost per lead. We want to track, and the way we're tracking accreditation is essentially this is through a form of Facebook. So the lead itself, the lead, the person is verifying for themselves if they, make more than $200,000 a year or have more than $1 million in net worth. And I think this is a key metric that we're not just tracking cost per lead, but we're going a step farther and saying, how much are we actually spending to get an accredited lead, which is the type of investors we work here at Aspen Funds. The second KPI, and again, I'm going to break down for you what each of these need to be as we go through these videos. Okay, so I'm just laying them out for you right now. The second one is the percentage of leads that come in that get booked on a phone or sales conversation with our IR team. Okay, so we're just going down the process here. The third is cost per call booked. How much is it actually costing us to get someone on the phone? And the reason this number is so important is because we found that the likelihood of someone investing, right? I mean, we could look at our database, and I say this all the time, that our guys, their main number is like time on the phone, because that really is what drives investment dollars through the door here. And so we want to know, how much is it actually costing our IR team to actually get at bats with investors? Cost per call held is another one. And then percentage of those held calls that get closed, meaning this is our closing ratio, right? So very simple to understand that. And then what is the total cost of capital as a percentage of ad spend is the last thing that we're looking at. So let's break these down here, okay? So let's take CPAL, for example. And really what I want to know here is this is kind of what we're shooting for, and I'll show you how these numbers break down. We're targeting a cost per accredited lead of less than $50. And then we want the percentage of leads that come in. We want, for every 100 accredited leads that come through our system, through our Facebook advertising, we want 15 of those to get booked. So 15%, that's a good metric for our setter. And just so you have an idea, in our process, we have an ad team that's running our ads. We have a full-time setter who's calling on those leads and booking leads for our sales guys or for our IR team. And so the cost per call book that we're targeting is less than $375. I'll show you why this makes sense in a minute, but I just want to show exactly how we're breaking this down and how we know if we're on or off course. Percent of those calls that get closed, meaning that those actually turn into investors for us. I want to see that for every 8 calls that our team gets on the phone with an investor, that one of those investors get closed. That's about a 12.5% closing rate. Our average deal size is $100,000. So these numbers are based on $100,000. And so I think that's really important to note. And then the cost of capital as a percentage of ad spend, we want to see less than 3%, right? So that allows us to be profitable early on if we can get our cost of capital and ad spend for less than 3%. So let me just break this down and show you why these numbers are so important. And if you're going to go spend money on Facebook, or you're going to go spend money really anywhere, you want to know what the math is. And really, this is why I think this process, it doesn't have to be going and, if you're going to go try and acquire investors, you shouldn't just be throwing money in a black hole. You should have a process. You should know your numbers. And this is how we do this. Okay. So if we're going to go spend $30,000 on ad spend at $50 a lead, we know, and I can map this out, that's 600 leads. Okay. 30,000 divided by 50 is 600. So if 15% of those leads are getting booked, that's 90 calls booked. Okay. At a 12.5% close ratio, that's 11 closed deals. So we spent $30,000 to get 11 new investors at $100,000 average investment amount. That's a total capital raise of $1.125 million, a cost of capital of 2.67% of ad spend. Okay, so let's break down each of these different layers or each of these different levers, I want to call them, and show you, and talk about how or what we're doing in order to make our process most efficient. If you're wondering, like, where do you start in this? Well, if you know your numbers, and the great thing about knowing, having this formula now and knowing your numbers is now you can kind of stand back and you can look at this objectively and you can say, okay, if I just can, cut the cost in half of my CPAL or cost per accredited lead, then I can double my investor leads. And this is the benefit of knowing this. And again, when you look at this, like really the easiest things to fix are typically top of funnel. They get harder to fix the lower you go down in the process, right? Like it's much easier to get cheaper lead costs than increase your conversion rate, right? In most cases, because maybe it's a better ad or it's a better messaging where, time on the phone or your sales process is a lot harder to tweak and get better at. And so let's talk about each of these levers. The first one being CPAL, so cost per accredited lead. And this is all about your offer and messaging. So there's kind of, I think there's one, two, it's kind of 4 or 5 components I'm going to talk about. The first one is a better offer. Like there's no substitute for your offer. And the way to have a great offer, honestly, the best thing you could do is just do something different that no one else is doing, right? If you can truly be unique in the market, this is how you can lower your cost per accredited lead. If you just have, I've worked across different offerings over this past year. One of them was RV park investing, right? RV park investing had the lowest CPAL across any deal that I worked on this year. Why? Because it was just different. No one else is out there offering RV park investing versus like a traditional multifamily deal. Of course, your cost per lead is going to be a lot higher because there's a lot of people doing multifamily investing. And so, if you have a unique offering, this is the best way to lower your cost because it's actually different. But what if you can't be unique? How do you create uniqueness in your offering if you are a multifamily investor and you are offering very similar products to what the market or very similar return profiles to what the market is offering? There's a couple ways. One is your structure. Do you have a unique structure in which you can offer to investors? Maybe it's a higher preferred return, right? Where the traditional 7%, 70-30, maybe you split that up. You do something completely different than what everyone else is offering. And you show that there's actually less risk to come into your deal than it would be in someone else's. The other thing I've seen that was really unique is just even the way kind of the sales process. And so I've seen groups where instead of, marketing the deal, they would market an investment tour to the actual property. And so it was a great way to get investors face to face with the firm. They would take them to pizza and beers afterwards. And this was their unique proposition because their deal was the same. It was a multifamily development project. But instead of saying, hey, come and invest in our multifamily development project, it was like, hey, come and see an actual property. Come and, put a hard hat on. Come and see the dirt. Let me teach you the development process. And then we'll go to lunch afterwards and we'll talk about what it looks like to invest with us. And this was their way of taking, a red ocean opportunity in a sense and creating a blue ocean type opportunity for their firm. So again, the first way to lower your CPAL is be unique. The second is make sure you're focusing on solving a problem. Let me be clear, like just talking about your returns or your track record is not solving a problem for investors. And so you really have to ask the question, what problem does my avatar have? And so here are a couple of examples, like since we're talking about investments, like investors have a tax problem. Some folks, no one likes paying the government more than they want to pay. That is a problem that a lot of people have. And so if your offering can solve that problem for investors, talk about it because that is an actual problem that people feel. They have a retirement problem, meaning they're not sure if they're going to have enough for retirement. That is something that potentially your investment can cure. I know that we've talked and gotten a lot of traction on our private credit fund, for example, because it is an opportunity where they can, they're not retired yet. They're about to be retired. So they don't want their money locked up for 10 years. They want something that can compound now, but when they're ready for retirement, they can take distributions, right? It has the flexibility as they approach retirement. So that is a way that we're solving kind of this gap in between where they're at today and where they're going to be in the next 2 to 3 years. So it's solving a problem for those type of clients. Do they have a predictability problem? Meaning I'm not sure how to generate passive cash flow. I'm not sure if my investments in the stock market are going to continue to grow and continue to protect me in retirement. Do they have a predictability problem? And can your offering create or provide more predictability for the investor. Diversification problem, right? This is a problem that a lot of investors have, is they're just not diversified enough in different offerings. And so can your product or can your solution offer a solution to that particular problem? And so this is where it takes time to really discover and really learn what are the problems that my core or my key avatar has, and can I actually solve that with my unique offering? The third thing is does it make sense? And I think this is so interesting. Like, imagine someone coming to you, and this is an example I use a lot because this happens to me. Like, imagine if someone came to you with like a video game investment opportunity. And if you're in the video game space, then think of something different. But for the most part, like, most people are like not going to, they're very unfamiliar with the world of video games as a business model, which it is a legit business model. Okay. There's lots and lots of money to be made in that industry, but it's something that I have no idea about. I don't understand it. So when someone comes pitches me for a video game model, what does my brain immediately do? It just shuts down. Like, I don't know it. I'm confused about it. I don't really have the time to learn about it. I'm out. And so I think you have to have the same exact mindset when you are pitching deals or when you're educating investors on deals. Is think about the video game analogy. This is like a video game analogy to most of them. They don't understand it. They don't get it. They don't see the unique selling proposition. So you have to take the time to educate and help them understand why this makes sense. The reality is we all think that everyone feels the same about our deals. And here's the reality. They do not. And so make it make sense for the investor. And then lastly, is it timely? This is so key to help investors understand why now, not, why is today the time to invest, not 12 months ago, and why they can't wait 12 months from now to invest. They have to invest today. Why is it timely for them to invest today? If you can focus on those 4 things, you will lower your CPAL. Okay, the second lever, right, in the process at the top of funnel is CPAL. The next level, the next lever that we're really looking at, keep KPI, is percentage of leads that get booked that come in. So again, we're just tracking accredited leads. We're not even actually calling non-accredited leads. So we're just focused on the self-verified accredited leads. And I want to know, what is our percentage of leads that come in that get booked on a sales call? For me, that number is 15%. That allows us to build a profitable business or acquisition channel through Facebook. And here is the number one and really the only thing that I have found that can really change this. It's speed to lead. How fast can you actually call, text, invite, make a contact touch point with that lead when it comes in? And I'm trying to train my team that this needs to be typically less than 10 minutes. If you can do it in 5 minutes, if you can do it in 3 minutes, great. We build automations that send a text message 2 minutes afterwards, and our sales team is supposed to follow up with that lead within 20 minutes. And I know that if we can get to that person, because think about it, they're on the phone right now. They just submitted it. As soon as they put the phone down and they go to the kitchen, or maybe they're at work, right? Who knows when you're going to get to them again? So speed to lead is everything, and trying to increase your percentage of booked leads that come in. So the third lever is cost per call booked. How much is it actually costing us to get someone scheduled with our sales team? And this, the key activity here is follow up. If you're reaching folks, your speed to lead, then maybe you can reduce the amount of touch points. But I find that it typically takes 7 to 8 different touch points to actually get someone scheduled on a call. So that could be, they're getting marketing emails from us as soon as they submit their information. They're getting text message follow-ups, and someone's calling them. And so we actually train our setters. They're calling in the first 20 minutes. If they don't get them, then we're going to call them every day for the first 5 days as a courtesy to book a call. And then we're going to continue to follow up with them. Not every day, but we might move that to once a week for the next 30 days, right? And so we're going to continue to put ourselves in front of them as a courtesy because they requested information about our investment opportunity. And so if we can, we can lower our cost per call book by how? By booking more calls. And the way to do that is continuing follow-up. That is really the best thing that we've seen there. So once you have the call booked, if you've been in sales, you know that it's not automatic that they show up. And so how are we making sure the cost per call booked and the cost per call held are very similar, right? We don't want that to be a big drop off because people don't show up. And so here's the best example I can give you. Think of the dentist's office. And if you've ever booked an appointment with the dentist, you know that you're typically booking those appointments 6 months out. And so they've mastered this process. If they know that, when the week comes of your appointment, that the dentist's office is calling you. And have you ever remembered or want to go to the dentist? No one likes going to the dentist. That's why they call you, they text you, they remind you to make sure that you're coming in. And so we have to take the same approach, is that when someone schedules a call with us, it doesn't mean that they're automatically going to show up. Okay. And so we want to make sure we have a reminder sequence in place, whether that's text message or email. And we want to give them a courtesy call 30 minutes before the phone call. Hey, just to remind you, if this is maybe a setter or someone like an assistant, you can have them do that. If it's just you on your team, a great shortcut to this is every morning, look at your calendar of scheduled calls and send them a video text message and just says, hey, John, this is Ellis Hammond here. I can't wait, to chat with you later today about investment opportunities with us. And what that does, it creates accountability. Now it's harder for them to back out because they've already developed a relationship with you and they see that you're a real person. And so if you don't have an assistant, like the dentist's office or concierge to call them half hour before, then just do the text message thing. I'm telling you, you'll see your cost per call go down. And then the last lever, right before the final result of just cost of capital, is the percentage of those calls that get closed. Like, what is your actual close rate? I mean, this is sales, and we're not here to talk about sales, but the tip I would give you is that typically in this process, this is a longer sales cycle. This is someone looking to make a multi-year decision with you. And so I always want to encourage, and train my IR guys that this is typically not going to be a one call close. You're building and developing a relationship with this person. And so what I've seen across multiple offerings and now multiple companies, this could be a 45 to 60 day sales process. And that's okay, because once you have the relationship, once you have the trust, what we found is that investors invest multiple times with us over a lifetime. And so it's really, really important to make sure, you're not giving them 12 months, but that you're more focused on building a relationship and you're giving time to close that deal. And so we typically see 45 to 60 day close cycle for a new lead coming in on average. And then that leads us to total cost of capital on ad spend. So I mentioned earlier in this video, regardless if you're not even advertising on Facebook, why is this important? Because all of us have an acquisition channel, regardless of where we're marketing. Okay. And so the real question to consider here as we, wrap up this video is what is your acquisition channel? Do you have a clear, strategy in trying to acquire new clients? And here's a couple of questions for you to consider. Do you know how much it costs you to get a lead into your system, right? So for someone to raise their hand or give you their email or give you their phone number, how much is that costing you? Are you tracking how many of those leads you're having a conversation with? So from the number of leads that come in from that strategy, how many of those are actually turning into booked appointments for you? And then how many of those conversations are actually turning into investors? And then just ask the question, like, how efficient is this model? Is this actually a strategy that is predictable and reliable? Because that's what a real business does. It has a reliable, predictable, efficient acquisition channel. The last thing I would say that most capital raisers don't consider is their investment on time or their return on time. So you might say, well, hey, I just acquire investors when I go to conferences or when I'm going to meetups. And so I don't really have an acquisition cost. Well, that's because you're not valuing your time, or you don't have a cost on your time. Because if you think about it, if you're going to 20 conferences a year, that's 40 or 50 days. If those conferences are 1 to 3 days, that you're not doing anything else. And so so it's really, really important to also take into consideration your time when you're trying to calculate, what your cost per capital is. Hey, if you're an experienced fund manager or capital raiser, meaning you've raised more than $1 million already of other people's money, and you want to diversify your offerings and work with an experienced operator to grow and scale your capital raising business, go to aspenfunds.us/fund manager and submit an application to become a partner, a fund of funds manager with Aspen Funds. As a partner, we provide all of the marketing material, even a fund of funds calculator, so you can transparently see how much you can earn as a partner with Aspen Funds. aspenfunds.us/fund manager.